Chinese stocks under pressure once again today. Worries over the region stalling recovery. And taking a look at the Hang Seng, Hong Kong's Hang Seng index approaching the lowest close that we've seen since 2019. Let's put this all in perspective. For that, we want to bring in Shehzad Qazi. He's China Beige Book's international managing director. And Shehzad, it's great to have you here on set with us. So we got the disappointing data out last week. We've seen that reflected in the recent market moves. The number of U.S. listed Chinese names under pressure once again today. What does that then look like going forward for investors? Are we going to continue to see this type of pressure surrounding a lot of this uncertainty?
Yeah, I think the first point to be made is that China's economic recovery, disappointing as it was over 2023, has come to an end. And markets are seeing this and markets are panicking. Now, the second question is, does Beijing step in with stimulus? And I think the answer for markets to understand is there will be stimulus, but it won't be big enough to save the stock market necessarily, or more importantly, to really juice investor returns. This is going to be about stabilizing the property market and putting a floor under growth.
Is what we've seen in China insulated, or is there some kind of overflow impact that you're also tracking right now?
Well, largely right now, this is insulated, right? As you look abroad, the good news for China is that international demand really didn't flag as much as people feared, so the manufacturing sector held up. And of course, internally, the commodity sector has actually done quite well, steel, copper, and that sort of thing.
And when you take a look to, you mentioned the fact that the stimulus that we could get not nearly enough to maybe what investors want, what shareholders want to play out within the sector. When we talk about some of that further pressure then, is the worst then not yet behind us? And when we take into account what that could mean then for investors, how bad could it get?
Yeah, look, I think growth in 2024 is actually going to be slower than what we got in 2023. And markets will not like that. So this will increasingly become about, this is more of a defensive play. And of course, what we need to understand is how soon can the property market be stabilized? Because right now prices are crashing, sales are down massively, the values of homes are just coming down month after month, quarter after quarter.
What's the best way to really encapsulate the sentiment or the tenor around the Chinese consumer right now, as investors would want to be tracking some of their own portfolio plays within the region?
Yeah, Chinese consumers actually showed up over the course of last summer. There was some revenge travel, there was some revenge spending in parts of the luxury market and so forth, but that is all gone. I think the overall wealth destruction that you've seen happen in the country over the last couple of years, Chinese consumers are now taking a step back. They need a broader recovery. They need to see the labor market getting better, the hiring numbers to get better before I think their confidence really returns.
And Shehzad, also for investors out there who maybe don't have exposure directly to China, but there is an impact when you talk about the impact that this could have on U.S. companies, given the trade relationship between the U.S. and China, although the relationship has been a bit strained here in recent years. In terms of the impact that could then have on U.S. companies, on global companies, what does that look like?
Yeah, again, we've got some bad news potentially ahead, right? Because if you're dependent on Chinese travel and tourism, or you're in the gaming industry, or you're selling into China, not only do you have very severe domestic competition, but now you have an overall market that has been slowing and doesn't look like it's going to be picking up massively anytime soon.
Geopolitically, I mean, we're here in 2024. We know that there's going to be a ton of talk about, and from candidates, about international relations and where they're willing to delve further into relations with certain countries and where they're perhaps separating ties. And that could vary a lot. How do business leaders need to be anticipating where those ties are going to perhaps net out by the end of these elections?
Yeah, look, I mean, geopolitical risk is just rising. Political risk within China is rising too, but from our angle over here, as we get into the election season, you are most likely going to get a candidate, Trump, who is going to be much more aggressive sounding on China than he was the first time around. That's going to put pressure on President Biden and his team to look like they're very serious about China too. So investors, corporate decision makers, they're about to start getting rattled a little bit here.
Do you expect any change?
I don't know how much.
In the White House?
If we get a Trump presidency, I think we're going to see a lot of aggressive maneuvers on the China front. They are getting ready to make massive revisions, talking about things like getting rid of China's permanent normal trading relation status, for example.
Shehzad, always a pleasure to get some of your insights here. Shehzad Qazi, who is the China Beige Book International Managing Director. Thanks so much.